Global market outlook, walking a tightrope. Central banks are walking a fine line between controlling inflation and avoiding a recession. We expect inflation to ease only gradually, causing the Fed to maintain its aggressive stance. Investors will also have to gauge the extent to which risks are priced. Within foundation core portfolios, we believe raising allocations to bonds at the expense of equities, adding multi-asset income strategies, and tilting towards Asia ex-Japan and UK equities are three ways to navigate this tightrope. Gold, inflation hedges, and private assets can help mitigate risks from Fed tightening. Opportunistic ideas include defensive sectors in the US-Europe, cyclical sectors in China, commodity currencies, and our longer-term investment themes. Investment strategy and key themes. US recession risks are rising sharply, but China is recovering. The second half of 2022 is expected to be dominated by three macroeconomic questions. The first is on US inflation. Has it peaked, or will it stay elevated or rise even further? The second, and related, question is whether the Fed will tighten policy to the point that it pushes the US economy into a recession within the next 6 to 12 months. The third is whether China's policy support will help the economy rebound and thus diverge from slowing the US and European economies. Our view is that US inflation likely peaked in H1. However, the pace of deceleration from here is likely to be slow, with inflation setting above 6% year-on-year by end of 2022, from 8% in H1 and 4% by Q2 23. While long-term inflation expectations remain capped for now, new supply chain disruptions and other oil price spike could send inflation higher. This means the Fed, which has committed unconditionally to combating price pressures, is likely to err on the side of tighter policy until it is clear inflation is turning sustainably lower. Thus, we now expect the Fed to raise rates by another 150 BPS to 3.25% by year-end, taking the rate beyond the Fed's neutral level of 2.5%. As Fed's policy turns restrictive, the risk of a US recession in the next 6 to 12 months will rise significantly. Nevertheless, a recession is not a foregone conclusion, especially given the strong US labour market. The Fed will have to walk a very thin tightrope as it tightens policy to ensure that the economy does not tip over. China, meanwhile, is on the opposite side of the economic cycle. Chinese policymakers have clearly signalled that they are willing to offer a reasonable level of policy support, leading us to believe the economy will gradually recover from the sharp downturn in H1. Is US recession already priced in by markets? The S&P 500 index has already fallen more than 20% since its 3rd January 2022 peak. This compares with a median 27% peak-to-trough decline during recessions since the 1950s. Comparing the magnitude of this year's sell-off with the three most recent US recessions suggests markets are currently pricing in about half to two-thirds probability of a recession. As you can see from the table below, there is a significant dispersion in equity market sell-offs around a recession, with history suggesting the deeper the recession, the bigger the drawdowns suffered by risk assets. How investors can navigate the uncertainty. We have three ideas for our foundation portfolio. 1. Add to bounds at the expense of equities. While one can debate the extent to which equities are pricing in recessionary outlook, what is clearer in our view is that the bond yields are looking increasingly attractive. US government bond yields, for example, appear past the surge phase that usually occurs in the early stages of a rise in yields. In a scenario where a recession is avoided, bond returns are likely to approximate the yield on offer today if the yields either remain range-bound or move only modestly and gradually higher. If a recession does occur, The return generated by the yield is likely to be bolstered by capital gains from rising bond prices, in example falling yields. In either scenario, the risk-reward of bonds has improved relative to equities, in our view, leading us to upgrade developed market investment-grade bonds to a core holding. We see a similarly attractive case for US and European HY bonds, where yields have risen because of both higher government bond yields and wider yield premiums. Asian USD bonds also look attractive, especially on the back of increasingly supportive Chinese policy measures to revive growth. 2. Add to income assets. Besides bonds, a range of income asset classes, including high dividend yielding equities and non-traditional income assets, now provide good value. See the multi-asset income section on page 7. The yield on our multi-asset income strategy is now above 6.4%, the highest since 2020. We see this as an attractive level, given it is sourced across a well-diversified range of income assets. The income basket has proven more resilient than equities or bonds so far this year. Within multi-asset income, we retain a preference for floating rate bonds, which can be a good hedge against the risk of a further rise in bond yields. We have, however, closed our preference for subordinated bonds. While we still find the absolute level of yields attractive, the erstwhile inexpensive valuations appear to have normalised. 3. Tilt equity focus to Asia ex-Japan, UK. Within equities, we believe there are two opportunities in today's markets. The first is in Asia ex-Japan equities, which we expect to outperform global equities based on an attractive starting valuation and rising policy support in China. Asian equity exposure also allows some diversification away from a US and Fed-centric view of markets. Within Asia, we prefer Chinese and Indian equities. The second opportunity is in UK equities, which we expect to benefit from its relatively larger weight towards value and dividend-yielding sectors, as well as from a more attractive valuation compared with the Euro area and the US. Where are the other opportunities? In addition to the 3 ideas for our foundation portfolio, opportunistic investors can benefit from the following strategies. Focus on value and defensive sectors in the US and EU. Equity sectors offer investors a way to reflect their macroeconomic views. In Europe and the US, our sector preferences are more defensive and value-focused. We like financials, supported by rising interest rates and bond yields. Energy, which can hedge against further rise in oil and gas prices. And healthcare, which is a defensive sector and offers value amid lower regulatory risks. China's pro-cyclical sectors as regulatory pressures eases. In China, our preferences are more pro-cyclical compared with the US and Europe, given our more positive view on the economy and earnings. We upgraded communication services to preferred as regulatory pressures start to ease somewhat amid a more supportive policy backdrop. We also upgraded materials to preferred, as it benefits from planned infrastructure spending. We continue to like the industrial sector, given it aligns with China's long-term policy priorities. These 3 sector preferences are in addition to our preference for the energy and financial sectors. Commodity currencies more resilient to USD strength. Besides equity sectors, we see opportunities in commodity currencies. While momentum remains in the USD's favour over a 1 to 3 month horizon, a peak in bond yields is likely to signal a USD top. While timing this turning point is difficult, we maintain a preference for commodity currencies, AUD, CAD, and NZD. We see them benefiting from 1, a rally to catch up with commodity prices, particularly if Chinese demand rebounds, and 2, a rise in policy rates of respective central banks, especially if the Fed pushes rate expectations higher. Using volatility to average into longer-term themes. Finally, This year's drawdown in equities is creating opportunities in our longer-term investment themes. While further volatility cannot be ruled out, particularly if the US economy goes into a recession, we continue to believe that our preferred themes, such as embracing a digital future and the winds of climate change, should benefit from a faster growth and earnings over a multi-year time horizon. A turning point in China's economy could also brighten the outlook for our China's Common Prosperity theme. Hedging against more pessimistic scenarios. Financial markets have demonstrated several times over recent decades that a perfect hedge that offers protection against all types of risk events does not exist. Nevertheless, we believe it is prudent to add some protection against scenarios where inflation stays high or where Fed tightening increases create unexpected accidents. Gold remains an attractive hedge against such risks, especially given how it has held up in the face of a strong USD and rising bond yields this year. However, we would also consider more direct inflation hedges, including private assets. Meanwhile, our upgrade to developed market government bonds should help to provide a hedge against further equity market risks as central banks walk the tightrope towards an economic soft landing. Foundation, tactical asset allocation, multi-asset income at a glance. Key highlights. The first half of 2022 has been rough for income investors. The US 10-year government bond yield soared, breaking above its 3.3% highs, hurting fixed income returns. The good news is that the yield on our multi-asset income allocation has risen to 6.4%, the highest since March 2020. With growth moderating and risks of inflation staying elevated for the rest of the year, central banks are likely to remain hawkish, keeping asset volatility elevated. We expect multi-asset income strategies to outperform a balanced allocation over the next 12 months. The high level of yield on offer, well-diversified sources of income, and regular cash payouts are likely to be favoured by investors in an elevated inflation environment. For fixed income assets, the environment has shifted from TINA. There is no alternative. To TARA, there are relevant alternatives. We increased bond allocations in our multi-asset income portfolio this month. Given the surge in the US 10-year government bond yield and much higher credit spreads across most bond assets YTD, we added exposure to most bond segments, notably in developed markets quality bonds, emerging markets, Asia USD bonds, and leverage loans. This month, we also closed our relative preference for European high dividend paying equities versus global dividend equities and sub-financials versus high yield bonds. Key chart. We are bullish on income strategies given more attractive yield on offer. Yields across most income assets are near multi-year highs. Number 1. Income to outshine balanced strategies. Risk assets and income strategies have had a very difficult start to the year against the backdrop of elevated inflation, moderating growth, and rising risk of a recession. Still, our multi-asset income allocation returned negative 11.6% since publishing our 2022 outlook, outperforming a balanced allocation by C.2%, as investors sought real cash flow and more defensive investing strategies. While we expect inflation to peak soon, upside risks remain. As such, strategies with real cash flows, such as multi-asset income and dividend equities, are being favoured over a balanced, purely growth-focused allocation. With ongoing macro uncertainties, income will be an important source of returns from a total return perspective. Higher and more diversified sources of income, relative to a more growth-orientated allocation, usually offer the benefit of reduced sensitivity to interest rates, mitigating valuation compression. Number 2. increased our allocation to fixed income. We are much more comfortable raising the weight of fixed income within our multi-asset income allocation to neutral after this year's repricing in bond yields. Market expectations of US Fed fund rates have converged to the Fed's, signalling the worst of the bond yield increases is likely behind us. We see rising value in bonds, with yields on DM investment-grade bonds highest since 2010. US 10-year inflation-adjusted yields have also risen sharply to positive territory, with markets likely to incrementally focus on downside risks to growth. We see a more benign outlook for quality bonds. Asia USD bonds continue to look attractive, given their high yields on offer and wider credit premium relative to US government bonds. We expect China to continue easing monetary policy, providing a more supportive macro backdrop relative to US and Europe, which are tightening policies. We continue to prefer floating rate notes, FRNs, given upside risks to inflation. However, we closed our preference for subordinated bonds. While we still find the absolute level of yields attractive, the unusual value they offered relative to more senior bonds has narrowed significantly. Number 3. Equity income still attractive long term. While the gap between equity dividend yield and nominal US 10-year government bond yield has narrowed in recent months, dividend-paying equities still offer a premium against inflation-adjusted bond yields. Furthermore, high dividend-yielding equities have historically outperformed traditional equities during high inflation regimes. Figure 9. Our equity allocation raises the potential of large drawdowns in the event of a recession. However, for equities, the risk of poor inflation-adjusted returns declines over the investment horizon. With cash and bonds, however, the risk of losing value in inflation-adjusted terms over the long run is higher. Hence, we maintain an overweight to dividend-paying equities. For investors who worry about further valuation compression due to higher interest rates, but remain confident about earnings growth, dividend equities offer a middle ground. Valuations for dividend equities also remains attractive, given a 21% discount to global equities. Total return approach to income. While it is debatable whether risk assets have bottomed, the opportunity set within income strategies is clearly looking attractive after this year's rise in interest rates, widening credit spreads, and spiking volatility. We believe a diversified approach to income generation, using a combination of income, growth, and non-core assets, will help mitigate risks of higher yields or an economic recession, while focusing on a total return approach to generating income. Our thematic ideas. Key themes. Below, we provide a brief interview of our open thematic ideas, coupled with some recent highlights. For further details, please read our Thematic Investing H2 2022 update. The winds of climate change. Climate-related themes have suffered alongside the sell-off in broad equity markets this year. Among our sub-themes, clean technology, including renewables, have outperformed global equities by C.5% since the start of June. Valuations are looking increasingly attractive, with 12-month forward PE ranging between 16.0 times to 29.6 times versus 13.8 times for global equities, despite mixed earnings revisions. The ongoing shift to net zero targets globally should help this theme in the long run. Production bottlenecks, chip shortages, and the sharp rise in battery costs have impacted EV margins and sales, driving downwards earnings revisions within the EV segment. Clean technology and green capex are likely to see a boost in demand in the coming months, given the rising threat of a complete severance of Russian gas exports to EU, leading up to winter. In line with the International Energy Agency's warning, European Commission President Ursula von der Leyen also reiterated a need to focus on investments on renewables, warning EU countries not to backtrack on their commitments. We remain convicted on our climate-related themes, given this push towards an accelerated green transition and increased investments into cleaner forms of energy. Embracing a digital future. Rising inflationary pressures and interest rates and growing risks of recession have weighed on global technology stocks, and the cybersecurity sector has not been spared. The cybersecurity sub-index has registered 24.5% loss YTD, but has fared favourably on a relative basis against the broader Nasdaq Composite Index. In the near term, the Fed's rate hike trajectory and the US inflation and growth outlook will remain dominant influences on the sector's performance. We, however, remain optimistic on the sector over the coming 6 to 12 months, given the relative resilience of cybersecurity spending in an economic downturn. The pandemic and growing tensions with Russia have accelerated many cybersecurity trends and contributed to a strong spending environment. The newly proposed SEC rules on cyber attack disclosure would also discourage public companies from cutting security budgets. On the valuation front, 12-month forward PE has fallen notably over the last few months to 32 times. The rising risk of a recession in the US could see this fall further and offer attractive buying opportunities for investors. China's common prosperity. The increasing probability of a recovery in China has allowed us to turn more optimistic on China-related themes. Technology and new economy infrastructure investments are expected to accelerate in H2 2022 as the use of cheap green loans expand, while fiscal and credit policies also turn more supportive. This will benefit sectors such as smart grids, wind, and solar power in our renewables sub-theme. The semiconductor industry, meanwhile, continues to benefit from substantial government support amid the ongoing US sanctions. The output is slowly recovering after disruptions to manufacturing activities in March and will continue to rise once COVID-19 related lockdowns subside. China's renewables sector has been able to regain ground on a relative basis against the broader Chinese and global equity markets, and valuation is fast approaching the previous high of 20 times. In the near term, Chinese demand for NEVs, which is a substantial component of our renewables sub-theme, could soften after strong year-on-year growth in the first half of 2022, as purchase tax cut boosts sales of small engine combustion cars at the expense of NEVs. The possible extension of NEV subsides into 2023 would also put a damper on front-loaded demand that has supported sales growth this year. We, however, remain positive on China's NEVs, given the expected acceleration in infrastructure investments, but we'll look to buy into the sector at a better entry price point. While the valuation multiple of the semiconductor sector has similarly risen in recent months, it remains at a depressed level when compared over a longer horizon. Ongoing government subsidies, procurement preferences, and other preferential policies mean the semiconductor industry is well positioned to capitalize on the rebound in customer demand when economic recovery gains traction in China.